please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me Anuj and Sonia. Well, let me start with the green note at least. Asian markets and Wall Street have large shades of green. Wall Street in particular, despite the fact that China imposed a retaliatory tariff of 10% on 60 billion worth of US goods. It was expected to be 20 billion, it was expected to be 25%. Since it was 10%, the markets are actually cheering that fact. But I don't know whether the rest of the developments are very positive for India. For one, crude is once again at 79. It may have moved off a little bit from highs of about 6 hours ago, but it is still very close to 79. And the combination with it is that US bond yields have surged to 3.05. Yeah. That could be because of Chinese dumping. One of the ways in which China can retaliate is by selling off US treasuries, which it owns. So for whatever, 3.05 of the world's most risk-free sovereign bond will have an impact on Indian yields as well, as if crude and rupee were not enough. In addition, you also have that the fact that the rupee fell rather substantially after Indian markets closed. At 3:30 when the Indian markets closed, the rupee was still at 72.55.6, but at 72.97 was a level we were not prepared for. So we are now talking 73, and the stock markets and bond markets will have to adjust to that. Bond markets adjusted incidentally. Yeah. Yields went up to 8.16. So that combo of rupee, crude, bond yields in the US, not looking very good at all.
Oh, not looking good at all. Lata, hi, morning. Anuj, morning. And we're seeing it in the numbers as well, right? I mean, if you look at how September has shaped up so far, the MSCI India Index is now down 6.2% this month. And a lot of that, underperformance came in the last 2 weeks itself. The Asia ex-Japan Index, all are down. Emerging Market Index also down. But India is now the worst performing of the lot. Even yesterday, the FI numbers, there was a big sell figure of 1,144 crores in the cash market. There was quite a bit of delivery-based selling seen in the financial names. So SBI saw almost 350 crores of selling, 300 crores of delivery-based selling in HDFC. So let's see how things shape up. But for now, most of the cues are still pointing to negatives versus positives. Anuj, morning. We were talking about a rupee at a lifetime low, Brent crude surging. How much of that do you think the market has already absorbed over the last 2 days? I mean, it's been 2 days of selling now. The Sensex is already down 800 points in 2 days. You think a lot of the news is in?
Morning, Sonia. We will find out. The market will give us a verdict. I think there's a good chance of a 70-80 point Nifty rally today because and I tell you one thing, because I do closing bell, there's a fair bit of advantage I get because of that, in being able to observe the market.
How much is factored in?
So this rupee move, Lata, it actually started at 3 p.m. And when that Brent news was coming in. So you saw that Brent crude move. In fact, yesterday for last half an hour, me and Surbi were only talking about that intraday move in crude.
In crude.
So crude actually is lower than where we left it at 3:30. It went to 79.4. From 78.2 to 79.4 was one way. And even dollar rupee, actually, if you see the future, from 72.5 to 72.8, it went till about 315. After that, it corrected a bit. And then again, it made a move towards 73. So, my sense is that, and with the way emerging markets are rallying right now, Hang Seng, for example, the Nifty has made a bit of a lower low on closing basis, but protected intraday low. 11,250 is sacrosanct. It all boils down to risk reward. For today, the trade is to try a long trade with a stop loss of around 11,250, which has been the recent low. If that goes, of course, then the possibility and probability of a move below 11,000 opens up. But I do feel that, the correction that I've been talking about for some time now, that perhaps culminated with yesterday's move. Okay. Somewhere around 11,250, at least for this series now, perhaps you have made a bit of a double bottom. Of course, we'll find out. That theory is nullified if today you break 11,250. If you don't do that, in that case, let's see, perhaps the market does try to see a bit of a recovery today. The problem for the market is that there's large selling in large stocks. The HDFC twins, Bajaj twins, Kotak, that's been relentless. But that can turn also, like dollar rupee, crude can also turn at some point. How much more do you want to beat the market on just, same trigger? Let's see. But a lot of panic was factored in yesterday between 3 to 3:30. And if we're not breaking 11,250, the weak shorts perhaps will cover. Today is also the weekly options expiry on Bank Nifty. So there's a chance that perhaps the first gap up gets sold into. But if the lower does not break, then from that point, there could be a decent short covering pullback that our market can see.
Okay. Well, we also had announcements coming from SEBI after the meeting. Now, that could be a little bit of positive, though it was largely factored in. The FBI circular is practically taken off.
Yeah.
I mean, all that the chairman said is that the Khan Committee recommendations have been broadly agreed to, which will mean that, this scare over the FBI, Indian-run FPIs doesn't exist. So that could be a positive. But that's really a minor positive. I still worry that the bond markets are in a bit of a limbo, and the news of the US bonds going up. Cost of capital is so important. It's not just bond market, it's cost of capital. And that's what the rise in the sovereign yield is telling you. I'm still a little worried. And of course, even, mutual fund margins are going down. All this immediately has perhaps a knee-jerk reaction in financial stocks. So I'm not feeling as good as Anuj, though I would want him to be right.
Yeah, okay. Well, we'll keep an eye out on 11,250, right? That was the intraday low that we saw last week, which has not been breached just yet. But, well, this morning at least, there are some indications that the start could be in the green. Let's see how things go. Let's take a look at what our wise experts have to say as we head into trade this morning. Manishi Ray Chaudhary of BNP Paribas says they downgraded India from an overweight to a neutral a quarter ago. He says declining consensus earnings estimates, risks to growth arising from the rupee depreciation and rising oil prices, deteriorating asset quality of banks and India's premium valuation relative to regional peers were the main reasons. Manishi says risks from currency, oil price and valuation still persist, so they maintain their neutral stance on the market.
Okay, we've got more opinion on equities. Nicholas Smithy of HSBC says their top-down strategy remains cautious and highly selective. He says emerging markets are going through a substantial repricing to reflect a more challenging funding environment, a higher risk premium, and pressure on global credit markets. He says this adjustment will likely last as long as the US Fed sticks to its tightening trajectory, which is more hawkish than market expectations, and global trade faces protectionist headwinds. Okay, that's the equity opinion. Let me now give you money market views. Pramit Brahmabat of Veracity says rupee is expected to remain in a range of 72.80, 73.20. He says we can see pressure on the rupee from global factors like trade wars and its effect on the Indian equity market.
All right, and Dhaval Dalal of Edelweiss says Indian government bonds gave up all their recent gains yesterday amidst news that crude oil prices are likely to hover at current levels. He says the US Treasury yields rising above the crucial 3% level also impacted sentiment. He says with the banking system liquidity tightening amidst advanced tax outflows, market participants are eagerly awaiting more open market operation bond purchases by the RBI to stabilize sentiment. He expects a 10-year benchmark bond yield to trade in a range of 8.1 to 8.25% in the near term.
Okay, better looking global cues this morning. Here's Rima with the world view.
Hi guys, good morning. Yes, absolutely. Global equity markets are largely upbeat as investors have shrugged off this escalation in trade conflict. As you can see on your screen, the big headline is that China has retaliated. They will impose a 10% tariff on US goods worth $60 billion effective 24th of September. However, they have lowered the tariffs on few goods from 20% earlier to now 10%. So investors are largely saying, well, this escalation in trade barbs is not as bad as what we had earlier anticipated. So US markets closed in the green. The Dow had a near 200-point rally. The Nasdaq has recouped part of the previous session's losses, so that ended higher by close to about 0.8%. The big talking point there is the fact that the US 10-year yield has also risen, now at 3.05%, the highest level since May. European markets too largely in the green. The big mover there was DAX with a gain of close to about 0.5%. Emerging markets too had a positive session. So Argentina, Russia, Brazil, across the board you had rallies with Argentina leading with a gain of nearly 3%. Asia, this morning too is showing you some green, barring the Korean market. So Nikkei is the one which is leading the rally with a gain of 1.5%, and Hang Seng too has a rally of close to about 1%. For the Indian markets, when you track the macros, as Anuj pointed out, Brent was at a higher level yesterday. So yesterday it hit a level of 79.73. So compared to that level this morning, it has eased a bit and now trading below that $79 per barrel mark. And the dollar index continues to hover around the 94.6, 94.7 mark. The SGX Nifty is currently mildly in the green.
Okay, thank you very much for that, Rima. And with that, let's tell you what we have lined up for you. Today is a big day because the JP Morgan Third India Investor Summit kicks off, and we have an array of guests from this securities company to speak to us. In a minute, we will be speaking with Sunil Garg, the head of institutional equity research. We will also have Jahangir, the head of economics research later on in the morning. And then, of course, we have James Sullivan, their head of Asia ex-Japan equities, Pedro Martins, the managing director of global research, Filippo Gori, the head of markets and investor services. I mean, I could go on. We have a long list of guests from JP Morgan who will be joining us. But to kickstart the JP Morgan conference and what we expect from there, Sunil Garg, head of international equity research, is there for you on your screen. You can see him. Thank you very much, Sunil. Sorry to pull you out at an hour that will be very busy for you out there. But, you know, the markets are looking so roiled. How uncomfortable are you with this emerging market sell-off? Do you see that continuing?
So, Lata, first of all, thank you for having me on the show. And I guess before we talk about emerging markets, I think it's a sign of at least our confidence in emerging markets, and in particular in India, that, you know, very, very pleased to have our third India Summit in Delhi here. And I think the conference continues to grow each year. We've got leaders from over 80 companies and investors from over 200 investors in Delhi here, along with policymakers and government officials. So we're really looking forward to a positive conference. Now, obviously, the backdrop, as you mentioned, I think it's been a pretty rocky last few months for emerging markets. In fact, I think emerging markets since the peak in February are down nearly a quarter, and currency is playing a big role. It clearly is some cause for concern because, you know, we've lowered our estimates in terms of target price for MSCI Emerging Market Index and also some of the EPS numbers. But the fact remains that emerging markets are very cheap, and in fact, they're trading at a much wider discount to historical averages. And that at least provides a value floor in emerging markets. So overall, we are positive. I think the big driver here, it's going to be China, because China has been a massive underperformer. So it's not just some of the Latin American currencies that have been weak, but it's China's equity market that has been dragging down EM performance. China's obviously, on one hand, there are trade tensions which impact, but it really is their domestic stimulus which we think will come through. But China is the big call here on EM. So overall, I mean, you know, despite all the pressures, we're positive and looking for EMs to bottom out from here.
Okay. Sunil, hi, good morning, and thanks for joining us on the show. You said you've lowered your MSCI Emerging Market Index target. How much have you lowered it to? And what's your view on MSCI India? How do you see it shape up over the next, say, 6 to 12 months?
So our MSCI Emerging Market Index, we've lowered it by about 8%. So 1130 is our target versus where we were about 1230 earlier. I think India is an interesting story where it's been a very strong outperformer both in an Asian and in an emerging market context over the last many months. But that's started to come under some pressure more recently. And I think we do have some reason for caution. First of all, we've had a very strong performance from here. I think in terms of where our Nifty targets are, it's probably a relatively modest upside at this point in time. If you look at some of the high-frequency data points coming through, whether it's PMI, whether it's rainfall, whether it's you know, the pressures from oil prices, I think these are going to be acting as headwinds. And we think the consensus earnings estimates are probably a bit too rich. They're about somewhere between 21 and 25% for either MSCI India or Nifty, and we think it's going to be closer to 15%. And we've seen a EPS downward revision trajectory come through. So I do think that at a market level, we're probably in for some headwinds in the short term, which is why we think it's probably better to look at bottom-up opportunities.
Okay, Sunil, hi, good morning. That's interesting because you're saying perhaps you should be looking at bottom-up opportunities. For Indian market, there's been two legs of a big bull market. There's consumption and the companies that finance that consumption, and both have seen quite a bit of correction over the last few weeks. You reckon they could correct more from here?
So, look, I think financials are still not a very attractive sector in the Indian market at the moment. In fact, I think financials have struggled pretty much everywhere globally, even in developed markets, and that's not one of our preferred sectors. And interestingly, if you look at consumption, then the discretionary part, and particularly the automobiles, have been a lot worse off. So I think there's probably interesting opportunities in sectors like healthcare. Now, that may not necessarily be a domestic consumption story, but that's also been a very large underperformer if you take a one-year context, and I think that looks like one of the better opportunities at the moment.
Okay. Sunil, more particularly in India, we have seen a very sharp rise in bond yields to about 8.2%, the Indian 10-year. At least 50 basis points higher than what it was a month ago. Today we see the US bond 10-year clocking 3.05. How much worse does the cost of capital get, and will that add fresh reverses to the financial sector?
So I think very clearly, higher interest rates do have an implication in terms of the cost of capital rising for companies. We actually think that higher bond yields are a sign of confidence, and typically, historically, and particularly in developed markets, they've been associated with better equity markets rather than the other way around. So in some senses, we are seeing a interest raising cycle pretty much everywhere. I think our concern more recently has been a flatter yield curve, so if bond yields are rising, I think that's actually a better outcome. So yes, it does raise the cost of capital, but if it is accompanied with a better growth outlook, then I think that's net-net a better outcome. So we actually think higher bond yields are going to feed through into a better outcome.
Okay, that's interesting. What about flows, Sunil? In your interaction with foreign investors, how is the mood with respect to investing into India now, especially considering the way the rupee has moved? Would you expect more redemptions from FIIs?
So I think the overall sentiment for India is, not unscathed from the softening of the stance on emerging markets. And as I mentioned earlier, with a 25% decline over a 6-7 month period, I think some of the confidence in EMs have been shaken, and we've seen redemptions come through. And again, more recently, the rupee, which was largely stable over the last month or so, particularly in August, has been one of the worst performing currencies. So there's definitely weighing on the sentiment. I think overall emerging market positioning at the moment is light. And I think India is, as I again mentioned earlier, has been one of the stronger outperformers. So, there's clearly a possibility that as investors get more comfortable with emerging markets, it rotates into markets that have massively underperformed. And that would be places like China and some of the CEMEA and the Latin American markets.
Okay. Sunil, generally what is your preference within India itself? Are you only sticking to consumption, or are you looking at more dollar-denominated stocks or dollar earnings stocks like IT and pharma? And by the way, does the rupee worry you at all at 73?
Look, I mean, obviously the pace of decline combined with oil prices, which are nearly at $80, is clearly a bigger impact for India than perhaps for many other economies. So I think as a result of that, the current account deficit itself is going to widen quite substantially from just under 2% to nearly 3%. So it clearly is a headwind. One can't deny that. But I think if we take it in the context of how much other emerging market currencies have declined and the pressures they've had, I think some of this was, par for the course. So yes, it is something we see as a headwind for the market, but it's not something which gives us, huge concerns. But when combined with a very strong outperformance and some of these headwinds building, that's the reason for some of the headline caution on the market. Now, I think if we look at, where we are looking for, better placed sectors, I think it really is, the cost of sounding boring, where we see better growth opportunities. Now, two of these sectors that we like do have dollar-denominated earnings, healthcare and tech. So, but I think it's not just that. I think we've also had, as I mentioned, in healthcare, you've had a period of large underperformance that is reversing, and so, but they tend to be dollar denominated. The other space that we like quite a bit is materials, so that's looking like in a pretty strong shape. At this point, financials, which is usually one of the reflections, one of the opportunities to play a domestic story, is not something we're very bullish on at the moment.
Okay, but coming back to your earlier stance on the markets, there have been a lot of downgrades that we've seen in India of late, and in fact the FI holdings into India is also down from an all-time high. JP Morgan is still relatively bullish. Why is that?
See, are we talking about India or are we talking about global markets?
India.
India.
So, I mean, our index target has about 7-8% upside. Now, is that, ultra bullish over a 9-month period? I think it's not a bearish view, but I think the markets, got a bit of a, I would say, volatile time ahead. I think you've also got an election year which poses some headwinds. So I think relative to other emerging markets, there are headwinds that we're seeing here. We're not bearish on India, but I think the index, having delivered such strong performance at the aggregate level, is probably going to struggle a bit from here.
Okay, Sunil Garg, well, that's cautious but still optimistic, I would think. Thank you very much for joining us. Have a great conference out there, and we look eagerly forward to your other guests joining us, your other colleagues joining us. Okay, so that's the word coming in from JP Morgan. A little worried about India's levels at this point in time, but, well, not too bothered. We take a break on that note. We are coming back with our own team with TV18's top 10 list of stocks.
Morning, the Asian markets, let's just take a look at them. Most of them are actually in the green. The SGX Nifty has moved to the high point. The Hong Kong market is now up almost 300 points. Shanghai is up more than 1%, so looking pretty good for Asia. Let's see how our own markets pan out. For now, investors have shrugged off the escalating US-China trade tensions. But our research team is here to give you the list of top 10 stocks as we head into trade today. So let's go straight to them. Anuj, what are you looking at now?
So, one green, one red, perhaps that kind of days, Sonia. TVS Motor, I think, been pointing out about this stock since, 530, 540 now. Went to almost 600 yesterday. It's up 4% this month. The auto index is down 4%. So, it's an 8% index outperformance that it's shown. It's ended its bear market, which is quite visible, and it's been slowly moving up. So, that's an interesting one for me. Jindal SAW is on the downside. It's a stock where you had a counter trend rally, and that rally looked good while it was there, but it's over now, and the delivery volumes were double yesterday on the way down, so perhaps some more weakness in the stock.
Okay. Well, yesterday post-market, the SEBI announced a bunch of decisions, and one of it was that asset management companies, mutual fund guys, can't charge you too much by way of expenses. Rima, tell us, what was the sum and substance?
Well, the big headline is that SEBI has cut the total expense ratio of mutual funds by 15 to 25 basis points. And this is over and above the 15 basis points cut that had been imposed on the total expense ratio in June. Now, this will pressure the profitability of the mutual fund. But the question is, are the mutual funds currently operating below the cap, which is specified of TER? Will they be able to pass it on to the distributors by way of lower commissions to defend the profitability, or will they absorb it? If they absorb it, then yes, the profitability of mutual funds gets impacted. Nomura has downgraded a Reliance Nippon AMC to a neutral. They've cut the target price to 210, while Morgan Stanley is written on HDFC AMC, where they maintain an overweight, but they've lowered the target price to 1765 on the back of these developments.
Okay, thanks for that. CLSA has also written a note where they say equity AUMs form 40% of total AUMs for the sector, and this could lead to a 25% negative impact on the sector earnings in FY19, or a 17% impact for a couple of names like Reliance AMC and HDFC AMC. But we did get some reactions actually. Let's listen to that. Here's Ashish Somaya, the CEO of Motilal Mutual Fund, talking about this.
The point that you cannot pay upfront commissions means that even if there was any scope to influence someone by way of commissions, then I think that is out of the window. And I think in the investor interests, the AMC's interests, and the advisor or distributor's interests, everything gets aligned, because if you are in the fund and the fund is performing, then everybody gets their due fees. My sense is that the gross inflow would decline, and at the same time, the rotation or churn of funds, someone moving in and moving out, that also would decline. So I think on the inflows, outflows across the board, I think you will see slightly lower volumes than what you have been seeing in the past.
Okay, well, Ekta's not in, so Sonia's filling in for her. Sun Pharma, some news?
Yes, there's positive news flow there. A dermatology medicine has got an approval from the European Commission. So their Spanish company from which they out-licensed this medicine, Almiral, has received the Euro approval for a psoriasis drug, Ilumetri. That's a dermatology medicine. And the rollout of this medication in Europe will start over the next 2 weeks. They haven't given any numbers, but this is sentiment positive for them.
Okay, sentiment positive is what we have for Sun Pharma. There's a newspaper report about Lakshmi Vilas Bank. Well, of course, ever since I've joined, this profession, I've heard news on stake sale in Lakshmi Vilas Bank.
Lakshmi Vilas, Karnataka,
in Karnataka,
Karur
all of them, yes.
No, but this one, I may believe, I mean, we don't know whether, well, the news itself is that Barings PE of Asia, the private equity company, is looking to buy a 26% stake in this company. Now, what gives credence to it is that Lakshmi Vilas now desperately needs capital. In the last count, its gross NPAs went to 10.7. A year ago, it was 3.7. So clearly, the asset quality review and the RBI circulars have hit them badly. We did reach out to Barings PE, and they told us that they don't comment on market speculation. But that apart, this could be, a positive news that Lakshmi Vilas is clearly, rather frantically looking for capital.
But apart from Lakshmi Vilas, you're also looking at the other NBFCs, the PSU banks, after the big fall yesterday.
Yes, yes, that will always be. The big theme of the market itself would be, as Sunil Garg pointed out, financials and their poor showing. So after market closed yesterday, we saw a further spike in bond yields, and that's been topped up with the US bond yields going up to 3.05. These usually have a global impact. So I would expect early morning pressure on NBFCs and PSU banks for sure. How much that plays out will depend on how the rupee and bond markets progress and pan out thereafter. But the initial dip in these stocks looks likely.
Okay, well, one space is seeing some signs of a rebound. At least that's what brokerages are talking about. The real estate sector, that is. Sonal is here to tell us about those notes. Sonal, hi, morning.
Hi, good morning, Sonia. Well, we saw very weak real estate demand last year. The inventory levels were high. Also, the launches were very low. But it seems that there's a rebound in this sector currently, and that is what Citi and Macquarie are saying in their reports. Citi says that there are some signs of rebound. However, there is a still long way to go. They say that the residential new launches appear to be bottoming out, and they also think the commercial space that is doing well. The top pick for the brokerage is Phoenix Mills. However, they maintain a sell call on DLF. Macquarie also came out with a report. They say that they see recovery in residential segment, or also the rental growth and institutional interest continue in the rental assets. Phoenix Mills again is their top pick. Also, Prestige Estates is liked by them. Back to you.
Okay, Phoenix and Prestige. Thanks for that. That'll bring a lot of smile. That's a sector that's been beaten down for so long now. It's been a long recession for them. Anisha, you have some more stocks on your radar.
Well, yes, let me add to the cheer because RITES has bagged an order worth around 440 crores and that should be taken positively by the street. Moving on to ILFS Transportation. Now, the ILFS group has been under quite a bit of scanner given the huge debt that it owes. But there's a positive news that ITNL might get some compensation from NHAI to the tune of 400 odd crore rupees. So let's see how big that it could be the impact. MCX will be in focus because in the slew of reforms that were announced by SEBI yesterday, it also announced that the commodity derivative segment will be open to the foreign investors. There's a positive brokerage action as well. Motilal has written positively on that, so that shall be in focus. And lastly, on Som Distilleries, because one of the subsidiaries has launched one more new product, which is Blackford beer, and that should be taken positively by the street as well.
Okay, thanks for that. But the sugar space has been roaring lately. There is a cabinet meeting today and the cabinet may approve a subsidy for sugar exporters. Manisha Gupta, who tracks this space very closely. Manisha, what are you picking up? I mean, what could be the outcome of that cabinet meet?
Oh, well, yes, the sugar sector has been buzzing since we saw the ethanol price rise come in. But it really is about the arrears that the government has an eye on. And they had allowed 5 million tons of mandatory exports from the sector, which clearly hasn't happened. Not even 10% of that has been exported. So we are expecting the cabinet to pass on some export subsidy proposals today. One, of course, is about on cane. This would be given to the mills who will export. So nearly 14 to 15 rupees per quintal is what the markets are eyeing as in sense of subsidy here. The other subsidy would come in sense of transports, which would be between 1 to 3 rupees per quintal. So if these couple of things go through, the industry tells us that it would be viable then to export the surplus sugar out of the country, further supporting the prices and the stocks as well.
Okay, yeah, that would be welcome. Thank you very much, Manisha. We'll of course touch base with you shortly.
Okay, well, let's do a quick recap then in case you're wondering about all the stocks that will be in focus. With positive news flow, names like TVS Motors, Sun Pharma, Lakshmi Vilas Bank, Sri Renuka Sugars, Balrampur Chini, Bajaj Hindustan, Phoenix Mills, Prestige Estates, RITES, ILFS Transportation, MCX and Som Distilleries. While stocks with negative news flow, Jindal SAW, Reliance Nippon, HDFC AMC, the Nifty PSU Bank Index, HDFC, Bajaj Finance, M&M Finance and L&T Finance. We'll take a short break on that note. On the other side, our technical gurus Ashwini Gujral, Sudarshan Sukhani and Mitesh Thakkar will join in.